Hello everyone. I guess most of us all read this book, Intelligence Investor. So in this video, let's see what are all the 5 important key takeaways we can take it and remember all the time. Here, I don't want to bore you guys by just explaining theoretical. Instead, we'll be discussing 5 different stories to learn that particular 5 different key takeaways from this book. Let's start. The first key takeaway is understanding the difference between aggressive and defensive investing. Imagine we are at a horse race. We can bet on 2 horses. One horse, everyone's favorite. Everyone knows about that very well. In the history, it won multiple times, so most probably it will win again. But the problem here is that the prize money isn't much. Then the other horse, not many people think it will win, but if it does, we get lot of money. Now here the important question is, which one would you choose? Just like choosing in a horse race, investing is about making choices between taking a risk for more money or being safe for less money. So the first key takeaway from the intelligent investor is understanding the difference between aggressive and defensive investing. Aggressive investing is when we take bigger risk and the stock or index will face more ups and downs, but if we win lot of money. This is exactly like betting on the horse. Not many people think it will win in the race. Defensive investing is different. It's about keeping what we have safe and not taking many risks. This is like betting on the horse that everyone loves at the race. We may not win a lot of money, but we also won't lose what we have. Now think about if you bet on the least favorite horse. On the underdog horse. We might be excited when the race starts, but if we get nervous when our horse starts to fall behind, then we start to worry a lot about losing our money. It means we took on more risk than we could handle and the potential reward may not be worth the stress. This scenario illustrates the importance of understanding our risk tolerance and investment objectives. So, before investing, just like at the horse race, it's essential to weigh the potential rewards against the potential risk. Of course, both approaches have their pros and cons. Thus, this book recommends finding the right balance between the two based on our financial goals and risk tolerance. There is a famous quote in it. Managing investment is about managing risk, not just managing returns. Now, let's see the second important takeaway. It's about understanding a funny thing called Mr. Market. Imagine you have a house and you have a neighbor named Mr. Market. Every day he comes to your door and says he wants to buy your house or sell his house to you. Sometimes he is very happy and offers a high price for your house, and other times he is worried and offers his house to you for a very low price. Here we need to understand that Mr. Market changes his mind not because of good reasons rather than because of his feelings. This scenario illustrates the concept of Mr. Market, which is a metaphor used in the book to describe the stock market's daily fluctuations and volatility. Just like Mr. Market, the stock market can sometimes act without reason. It's our job as investors to stay calm and focused on those times. We shouldn't let Mr. Market's mood changes affect our investing decisions. Instead, we should think about what is the real value of the company and its future prospects. Just like the value of our house depends upon where it's located, how big it is, and its condition, the value of a company depends on its financial health, management, and potential to grow. So, when Mr. Market wants to sell us a company's share at a low price, it doesn't always mean that the company is not good. It might be that Mr. Market is feeling scared and negative about the company's short-term future. But as a smart investor, we should look past Mr. Market's feelings and focus on the company's real value. The big lesson here is that investors should not let their feelings to make their investment decision for them. Just like Mr. Market's mood changes, share prices can go up and down unexpectedly. And it's important to stay calm and make decisions based on careful thinking and analysis. Then the third important takeaway is about something called a safety margin. Imagine we are building a bridge and we want to make sure it's strong enough to handle all the people and cars that will cross in it, which is roughly 10,000 tons. That is the requirement. What should we do? Here, instead of building a bridge that just holds 10,000 tons, we need to build a bridge that can hold 15,000 tons. This extra strength is our safety margin, which helps the bridge to handle unexpected things like too many cars or a big storm, etc. Just like building a bridge, investing also needs a safety margin. When investing, we should look for companies that got safety margin or more in it, like financially strong, making stable earnings, and it got a good past record. By investing in such companies, we create a safety margin that can protect us from potential losses and increase our chances of winning in the long run. Figuring out the real value of a share and buying it at a lower price is also called the safety margin. Moving on, the fourth takeaway is the importance of diversification. Imagine we have a basket full of many different types of fruits like apple, oranges, bananas, grapes, and more. Each fruit is different in taste, feel, and the good stuff it gives to us. If one type of fruit goes bad, but still we have lots of other fruits to eat. Now think about if we have a basket filled with just only one type of fruit. If that fruit goes bad, then we have nothing left to eat. Basically, diversification means investing in different types of assets like stock, bonds, and real estate. This spreads our risk and reduces the chance of losing a lot if one investment doesn't do well. Just like the basket of fruits, investing in a variety of assets can help protect our investment portfolio if one investment does not do well. By diversifying our portfolio, we can increase our chances of making more money and decrease our chances of losing money. Diversification not only helps to reduce risk but can also lead to increased returns. By investing in different types of assets, we can get more chance for making money in different industries and markets. As per this book, a well diversified portfolio should have a mix of shares, bonds, and other investments with no single investment making up too much of the portfolio. By diversifying, investors can enjoy the growth of many sectors while reducing the impact of any one sector's downturn. And finally, the fifth main takeaway is the importance of fundamental analysis. Let's say we are thinking about buying a second hand car from a car dealer. The car looks good from outside, but we are not sure whether it's worth the price that the dealer is asking. So we start to ask questions about the car's history, like how many kilometers it has run, if it has ever had an accident, and if it's been taken care of properly. These questions are the way of doing fundamental analysis of the car. By knowing the car's history and condition, we can decide if the price is fair. Basically, fundamental analysis is like doing a health check of a company. We look at its financial condition, its position in the market, and its advantage over other companies to find out its real value. This can help investors to spot the shares that are priced too low or too high and make smarter investment choices. A company that is undervalued can be a good chance to buy because its share price is less than its real value. On the other hand, a company that is overvalued might be a good chance to sell because its share price is more than its real value. Always remember to do fundamental analysis before making any investment decisions. This will help you build a strong base for long-term success. So that's all. These are my 5 key takeaways from this book. I hope you guys got some useful information from this video. Thanks for watching.